থ্যাংক ইউ বলার কিছুই করছিল, ওখানে স্লাইড শেষ হবে, আমি তোমার হাতে হ্যান্ড ওভার করবো, তাই তো?
হ্যাঁ, তুই অভিষেক তাকে হ্যান্ড ওভার করবে। গুড মর্নিং।
গুড মর্নিং।
গুড মর্নিং। আচ্ছা, আমি একটা স্লাইড এক্সট্রা করে দিয়েছি, যেটা মানে পার্টিকুলারলি টু এমএসএমইস।
আচ্ছা, ওকে, গুড গুড,
হ্যাঁ
ভেরি
হ্যাঁ হ্যাঁ, এটা করে দিয়েছি, যেটা কি আমার রাইট এট দি এন্ড অফ মাই প্রেজেন্টেশন আমি ওটা দেখি,
হ্যাঁ, দ্যাটস গুড।
সেটা দেখিয়ে দেবো সেটা এতে।
10 o'clock we start, right?
হ্যাঁ হ্যাঁ হ্যাঁ, উই স্টার্ট রাইট এট 10।
Right on time.
Okay.
সবাই জয়েন করে যাচ্ছে, ভালোই হলো। অর্ণবের সঙ্গে কথা হয়ে গেছে, অর্ণব ইজ অলসো জয়েন।
আচ্ছা।
Should we start?
We can. I'm okay. Should I start?
Good morning. Welcome to our session on Union Budget 2021-22, moving forward with resilience. We are happy to have the session digitally this time. May I request our chairman of CII Eastern Region and MD and CEO Berger Paints India Limited, Mr. Abhijit Roy, to deliver the welcome address, please.
Thank you, Dr. Lekha Chakravarti, economist and professor, National Institute of Public Finance and Policy. Mr. P.P. Gupta, MD, Techno Electric and Engineering Company Limited. Mr. Prashant Khemka, founder, White Oak Capital. Mr. Arun Ramachandran, Director Taxation, Tata Consumer Products Limited. Mr. Naresh Pachisia, founder and MD, SKP Securities. Mr. Kuntal Sen, Executive Director, PwC. Mr. Arnab Basu, Managing Partner, East and Technology Consulting Leader, PwC. Mr. Pulak Saha, Partner, PwC. Mr. Kaushik Mukherjee, Co-Chairman, CII Eastern Region Economic Affairs and Taxation Subcommittee and Partner, PwC. Mr. Saikat Roy Chaudhary, Regional Director, CII East and Northeast. Ladies and gentlemen, friends from media, a very good morning to you all. It gives me immense pleasure to join the forum amongst this august gathering to welcome you all to the Union Budget 2021-22, moving forward with resilience discussion. On behalf of CII, I express my gratitude for your presence in our endeavor to review, appraise, and discuss the Union Budget of 21-22, which has been presented yesterday, 1st of February 2021. I take this opportunity to welcome Dr. Lekha Chakravarti, economist and professor, National Institute of Public Finance, Mr. P.P. Gupta, Mr. Prashant Khemka, Mr. Arun Ramachandran, Mr. Naresh Pachisia, Mr. Kuntal Sen, Mr. Arnab Basu, Mr. Pulak Saha, and Mr. Kaushik Mukherjee once again. The Union Budget was truly a transformative one, as it pulled out all levers within its ambit to mark yet another successful attempt by the government to rejuvenate a pandemic-ravaged economy. The bold measures, which encompassed almost all critical sectors of the economy, are expected to galvanize the recovery process which has been set into motion. The common taxpayers have been given relief by not raising the income tax. It is encouraging to note that the finance minister favored a major expansion in government spending with a focus on capital expenditure to give a fillip to demand generation and strengthening the recovery momentum. This was much warranted and is in line with what CII has been strongly advocating with the government. The 34.5% rise in the capex spending for financial year 22, mainly targeted towards major infrastructure expansion initiatives, are laudable. This is likely to have multiplier impact on the different sectors of the economy and develop confidence on growth beyond the current recovery. We are heartened to note that many of the CII recommendations, such as setting up of mega investment textile parks, development financial institution, national asset monetization pipeline, asset reconstruction and management company, are on the lines of the Bad Bank, has found a place in this budget. West Bengal has been given emphasis in this year's budget. Investment in Kolkata Siliguri highways, support scheme for women in tea estate will definitely boost the economy of the state. Increase in share of FDI in insurance is also a welcome move. In today's interactive sessions, we will deep dive in all these areas of the budget. This would be an effective platform for sharing knowledge to accelerate growth and ensure business impact. Now I would request Mr. Arnab Basu, Managing Partner, East PricewaterhouseCoopers, to deliver his address. Mr. Basu, please. Mr. Basu, is he there?
I think.
Kaushik, is Mr. Basu there?
He's trying to join. I think he's got some.
This is the other learning of online.
The online system.
Yes. You are muted is the most famous word that we have learned, in this period. Other one is technological challenge.
I think he's trying to join and.
By that time, let us introduce Mr. Arnab Basu. Arnab Basu is the managing partner for PwC. Sharbani, if you can go back. Yeah. In Eastern India and Bangladesh, and he also leads the technology consulting for PwC in India and also a part of the global technology leadership team. He also leads the industrial product sector within PwC Advisory. He has been with the firm for 18 years and specializes in large-scale business transformation using a variety of digital platforms and bringing to the integrated solutions around digital operation. He is also responsible for PwC's investments in emerging technology areas. He leads a few priority client relationships for PwC in the industrial product sector. Over to Mr. Basu. We are just waiting for him to join.
Arnab is just trying to get some technology issues, looks like.
Should we proceed?
Yeah,
with the
I think we can. Yeah, we can move to with the economics presentation, and then maybe Arnab can.
Yeah, Sharbani, if you can go to the next slide of speaker slide. Let me introduce Dr. Chakraborty. Yeah, we have with us Dr. Lekha Chakraborty, economist and professor, National Institute of Public Finance and Policy. She is also affiliated as research associate with the Levy Economics Institute of Bard College, New York. She is an elected board member of Governing Council of International Institute of Public Finance, Munich. She is the pioneer economist in institutionalizing gender budgeting in India. With Chief Economic Advisor, Ministry of Finance, Government of India in 2004, her areas of interest are macroeconomics of public finance, fiscal federation, extractive sector economics, financing human development, and gender budgeting. Over to you, Dr. Chakraborty.
Thank you. Thank you so much. Thanks for having me for this important deliberation, a day after our union budget. And talking to the business leaders is yet another ball game. I'm an economist. We talking among the academicians, and my language can go little technical, but I try to be non-technical as much as possible, and hope to have a deliberation with you. And I was asked to speak about the macroeconomic framework of this budget. And when we talk about the macroeconomic framework of this budget, the first thing coming to my mind is about the fiscal consolidation framework, because it is a mini budget in a way. What Prime Minister has highlighted, that for the first time ever in the history of India, we had so many mini budgets. And the day before also, it's in the series of those mini budgets for stimulating the economy. So in that sense, the
Ma'am,
fiscal
excuse me, ma'am.
yeah, tell
You
me.
can switch on your video.
Oh,
Is
I'm
it possible?
facing a lot of network issues.
Okay,
But
no issue. No issue.
yeah,
Yeah.
it's a lot for your kind understanding. Thank you. Yeah, let me continue then. Okay. Yeah. Okay, so fiscal consolidation is what's coming to my mind when I think about the macroeconomic framework. And if you look at the fiscal deficit numbers, it has gone up to over 9% of GDP. But we have an excessive deficit procedure on board to get back the deficit back, but not at 3% of GDP, but little higher over the period of time. So you can ask me that the fiscal consolidation path, the government of India is taking a longer route, or is it okay? So to me, I think deficit is good narrative floated by the finance minister in the context of pandemic is quite okay. So from that position of strength, she announced that her fiscal deficit to GDP has gone so much high, above 9%. So that is from a position of strength. For the first time ever, the government is talking about very high fiscal deficit numbers. This is quite a good, to me, it is quite a positive way of thinking about stimulating the economy, because if we are floating in the budget another fiscal austerity wave to succumb to the fiscal rule of 3% of GDP, the growth recovery would have been slower, and the humanitarian crisis would have been, huge. So in this moment, I do go by what finance minister has, announced, that don't fear deficit. So when I talk about don't fear deficit, we need to look into the context of the macroeconomic framework in which there was a transition from the discretion of the policy makers to do things to more or less it is very much rule based in the context of India. If you look at the RBI functions based on rule of the inflation targeting, and everything is dwindled down to just price stability as the only objective of center bank. And if you look at the fiscal policy side, it's again rule based, that we always believed in a golden rule of phasing out the revenue deficit, but there was an amendment in the fiscal rules a few years back, and yesterday also we placed the document was placed in the parliament about changing the FRBM Act. So to me, all these are very positive, and it is going to support growth. And another thing I would like to highlight is when we talk about the high deficit numbers, there is a crucial analysis that what are the determinants that led to the shooting up of fiscal deficit. When we talk about the fiscal consolidation, if it is through the expenditure compression rather than tax buoyancy, the quality of fiscal consolidation suffers. So finance minister has rightly argued that my numbers have gone up in the context of revenue uncertainty. So when there is revenue uncertainty, and when there will be the corresponding expenditure compression, if it is based on the revenue stability concept, we would not have got that part of economic recovery called quite sustainable. So that's my take. So I felt deficit is good narrative at this moment is quite good, because fiscal discipline cannot be growth enhancing in the time of pandemic. Now let's unpack where exactly finance minister has puts the money, or where the economic stimulus. It's not a blind stimulus going for a major universal basic income or a kind of helicopter dropping of money into the hands of people and firms. It was not that route finance minister has taken this time. Rather, she has gone for many targeted announcements when we talk about the fiscal stimulus. And in the targeted announcements, she has given quite a emphasis on the capital infrastructure investment and health investment. And when I talk about the capital infrastructure investment, of course, when you look at the numbers, it may not be over 2% of GDP, the union government's emphasis on the capital expenditure, but that, signaling that the government is going for a huge capital, infrastructure projects, and the institutional reforms related to this are getting rolled out. So this is giving quite a bit of signaling to the private corporate sector that the investment is going to be crowding in rather than crowding out when we talk about the high fiscal deficit. So the investors' confidence is going to get boosted up, because the moment we announced that my fiscal deficit is going to shoot up, because it is to support the investment potential, and this was long due. So this signaling, I value. And the institutional reforms in the sector of, even the financing patterns through the PPP models, there is quite a bit of ambiguity and it's not clear at this moment. But the budget is not everything, but it has, started the process. But in the due course, we need to see that what are announcements related to the PPP models in the context of infrastructure investment, whether that will be implemented or executed properly. So announcement, the big brains, they come, the business leaders, academicians, and the policymakers, they come together and float good ideas in the country, but the implementation and the execution is yet another. So we need to see that we get both quite right to get the economic recovery sustainable. And when I talk about investment, monetary policy has got limitations when we talk about the macroeconomic framework of investment. You know why? Because rate of interest and the investment, it may not be having a one-to-one relationship. Otherwise, the repo rate was coming down over a long period. Why there was not a one-to-one trigger in the investment and there was a recovery in the economic growth? So there are infrastructure bottlenecks in which the fiscal redominance was required. So that's a macroeconomic framework which was quite, relevant when we talk about the Union Budget 2021. Now coming to the social infrastructure, physical infrastructure, quite a bit of announcement related to economic firefighting, and the long-term reforms were announced. And when it comes to the social infrastructure, health was given importance. So it was a targeted economic stimulus announcement. And on the one hand, as per the recommendations of the 15th Finance Commission, the government has, is going to try a convergence in the centrally sponsored schemes or top-down schemes in the area of social infrastructure. At the same time, they floated a new, a centrally sponsored scheme yesterday, like Pradhan Mantri Atmanirbhar Swasth Yojana. So this has to be in the context of the cooperative federalism. Otherwise, if it is getting into the fiscal autonomy or the functional autonomy of the state governments, then it's going to be a different game. But at the same time, if the center can handhold with the funds devolution and can be little flexible, but not the tied funds in that sense, then we will not be able to work it out the heterogeneous factors at the state level. Otherwise, the emphasis is quite right. Rather than going for a health insurance package that I'm going to give health free for all, instead of that announcement, the announcement was to strengthen the physical infrastructure in the public health sector. And this was quite inevitable, to strengthen the public sector infrastructure rather than announcing an insurance scheme. Because insurance scheme, the studies have shown that it can out of pocket expenses is quite huge when it comes to the health spending. And to support that, government may float a good lemon, that's a health insurance. insurance package by the government. But studies have shown that even the public or the government supported insurance scheme can lead the expenditure of the households little more catastrophic, because it can lead to the system, the health system, overall expensive, and the kind of interpretation and the kind of amount they will get by interpreting it to the insurance companies, it may not be covering the the full thing. So the catastrophic nature of the health spending at the household level or the individual level may go more catastrophic if such kind of interpretation issues, especially when it comes to covering the health through an insurance. So this is a right kind of announcement that we are going to strengthen primary, secondary, and the tertiary health sector to the boost the social sector, in social infrastructural sector. So that I quite value. Now, coming to the political economy of this budget, the macroeconomic framework, there are studies by, economists globally that the dominant political party at the national level and at the subnational governments in the party in politics, they are quite different. There is a kind of, the bias can enter into these models in the way in which the cooperative federalism can operate. So yesterday's budget, if you look at that political economy, actually the consent, the calculus of consent or the calculus of voting, we are getting into the election mode right now. So they announced quite a bit of infrastructure packages for the states in which, the dominant political party at the center are not in power. So, it's a kind of, nudging the calculus of consent of people. So we have to see whether this experiment is successful, because it is in a way government is signaling through the budgetary allocations, through the fiscal policy tools, that we are there for you and we are getting ready. But at the same time, there are other non-economic factors which are playing, at the ground level, whether it is economics of ethno-fragmentation or whether it is economics of religion. So, which variable play is going to play, that calculus of consent or the voters' mandate, that only forthcoming elections can say. But that signaling, the political economy was quite interesting when I noted that, in the states like Kerala, West Bengal, Assam, there's a kind of announcement for the physical infrastructure, the state level, supported by the, the center. And these are the quick points I thought that I will highlight, and I will take the questions later and, mingle with you. Thank you.
Thank you so much, Dr. Chakraborty. Thank you for being with us. Please stay with us for some time for taking the question answer. Now, may I request Mr. Arnab Basu, Partner and Advisory Leader, PwC India, to deliver the theme address, please.
Thank you, Abhishekta.
Sharbani, can we have the speaker slide of Mr. Basu? Yeah, Mr. Basu is the managing partner. We have already introduced him to, so may I request Mr. Basu to deliver his address. Mr. Basu, over to you.
Yeah, am I audible?
Yeah.
Okay. Good morning, ladies and gentlemen. It's obviously a privilege to be here with CII, and PwC is really proud to be partnering with CII over the years and bring to you our budget observations. Yesterday, we saw the, sort of the first digitally delivered budget. And I think it shows the focus of government in truly building a digital India. And whether it is the focus on the digital census, whether it is around enabling the ecosystems, whether around building a digital first mindset, whether it's in digital first mindset in the field of education, around fintech, I think the focus was very clear. The focus was obviously very clear on investments in digital India, investments in self-reliance, investments in inclusiveness. And when we look at what the budget gave us, I think it's a very positive budget with key announcements coming around job creation through private and public investments, Of course, there was a major boost to health and well-being, whether we look at the 137% increase in budget allocation for the sectors, launch of the Atmanirbhar Swasth Bharat, we look at the Mission Poshan 2.0, allocation of INR 350 billion for COVID-19 vaccines, and of course, expansion of the health information portal to connect to all the public health labs across all the states and union territories. I think the other big thing which came out in yesterday's budget was the support the MSMEs, and I think it was very much required. And we were all hoping that the government would think about them. It has been a hard year for the MSMEs, and the support to the MSMEs by doubling the allocation for the Ministry of Micro, Small and Medium Enterprises, was a very welcome move. In terms of improving the access to credit for the MSMEs was also a very, very important step, I would say, whether it is through, setting up of the new asset reconstruction company, the asset management company to take over the stressed assets of the banks. I think that was the other big thing which we talked about yesterday. We heard from the Honorable Finance Minister how setting up of a development finance institution to finance infrastructure projects and equity infusion to the tune of 200 billion INR would be taken up. So all in all, I think it was very heartening to hear the Finance Minister talk about these. A lot of it would obviously, we heard the previous speaker, a lot of it would depend on the implementation. So I think budget, of course, shows the intent, but then the intent has to also fructify in the actual implementation. I think the other one which we felt very interested was improving the ease of doing business by, whether by setting up of a conciliatory mechanism for quick resolution of contractual disputes, strengthening of the NCLT system, adoption of the e-courts, setting up the alternative mechanism of debt resolution, even the decriminalization of the Limited Liability Partnership Act. All of these are great initiatives and great steps towards improving the ease of doing business. So I think overall, when we look at the budget, I think we are very positive about it. Of course, I'm not the tax expert, and we have quite a few of my tax colleagues who are experts in the field, who have been up the entire night yesterday going through the fine print, because sometimes the devil lies in the detail, and who would bring to you their perspectives of how they read the budget. But we are very positive about it, and we think that this is a growth budget. It would help in reviving India's growth story, and we are all looking forward to it. So with that, Abhishekta, I will hand it back to you. And again, welcome, ladies and gentlemen, to this budget session, and stay on for some really sharp initiatives being dissected by the experts. Thank you.
If you can share the sharing of content, I've got a slide deck to present.
Yes, I have done it, sir.
Okay, thank you.
We would request our delegates to write the questions in the chat box, please. After the technical session, we will take all the questions together before we proceed to the sectoral panel discussion. So may I now request Mr. Kaushik Mukherjee to deliver his technical address on the direct tax analysis. Mr. Kaushik Mukherjee is our co-chairman, CI Eastern Region, Economic Affairs and Taxation Subcommittee, and partner PwC. Sharbani, if you can show the slide also. He is a chartered accountant and a Bachelor of Law with an experienced professional career in direct taxes over 30 years. In his professional capacity, he has been advising various large and medium Indian and multinational clients. Several cases successfully handled by him at the Income Tax Appellate Tribunal are reported in leading tax journals in India. He is the co-chair of CII Eastern Region Economic Affairs and Taxation Subcommittee. He regularly addresses seminars and conferences in India and abroad. Over to you, Mr. Mukherjee, for your perspective on direct tax.
Thank you, Abhishek. I'll just present my deck and
Yeah. Meanwhile, we will request delegates to write your questions here, or you can raise your hand also. We can ask the questions during the questions session just after the technical session.
is the content visible?
Yes, yes. If you can make it full screen, yeah.
Yeah, thank you. Thank you very much, Abhishekta, and thank you, CII. Good morning, ladies and gentlemen. This time, the finance minister spent, not much of her time on the tax proposals, though in the fine prints there are a few things which have been brought in. But one of the things, the way that she started the budget with was that the economy was and the budget was based on 6 pillars, which was there. And while, when she came to the part B of her presentation, she talked about 4 basic ingredients of the tax system which she wanted to keep in mind in introducing the proposals. So these are, if we call it the pillars of the tax system that she mentioned, one is transparency, the next one is efficiency, the third one is promoting investment and employment, and the fourth one is minimum burden on the taxpayers. So if we categorize various measures, the various key measures of this budget, you'll see that over a period of time the government has been introducing various measures which are intended towards transparency and efficiency, and also towards promoting investment, employment, as well as lessening the burden on the taxpayers. So there are different measures which have been brought in. Some time back, we had seen that the faceless assessment and faceless appeal was brought in, and which is currently in progress. The first set of assessments and the appeals are under progress now on the faceless basis. A lot of questions and issues have been raised on there. How that will be successful, how things will be there, which obviously we'll have to see how those are implemented. But the government has now gone a step further to introduce the mechanism of faceless income tax appellate tribunal. So this is really a paradigm shift from the way the courts have been conducted. I do not know whether that will move up the ladder in terms of whether high courts and the Supreme Court will also be conducting its hearings or the appeals in a faceless manner. No doubt, it will be online, hearings which will be there, but the hearings are only if those are required. So that is something which is important. One needs to see that whether such a faceless faceless ITAT, where the revenue is a party in the appeal, they can cope up with the pressure, because one of the biggest things which is there is that in a faceless ITAT, faceless appeal, there needs to be there needs to be a good amount of written submission with facts and documents which have to be filed. So therefore, that is something which one would need to see that over there. The other things, I'll come to it later, in greater detail on all these items. So we have seen, the proposals include advanced ruling revamp, there will be a board of advance ruling that will be introduced instead of the current authority for advance ruling. The dispute resolution committee for small tax disputes for smaller taxpayers, that will be there. And then evolution of the settlement commission. This is something, where a lot of issues and things came up in settlement commission, that also, will be introduced. We have seen the government, bringing in the taxpayers charter, which is, bringing the taxpayer charter under the law. So that is something which is there. Now the government has brought in, and, this is from both sides, the reduction in time limits. On the one hand, the revised returns need to be filed within, within the assessment year for which the return is being filed, and now that closes on, on 31st of December. So that is something which is, which has been there. And on the other hand, the reassessments also can't be, unending, going on for years together. So therefore, and it is very difficult to retrieve old records, get old facts, etc. So therefore, the returns and reassessments also are being, the period is being shortened. Then there will be a shift from TCS to TDS on purchase of goods. So that's definitely leads to quite a lot of, I would say, reduces the not only the burden on the taxpayers, but brings in a lot of efficiency in the system. Then for promoting investment, there'll be tax relief for dividend, which has been brought in. I'll talk about it later in greater detail. Then benefits for startups have been extended. Affordable housing tax holiday and deductions on that account have been are extended here. Small educational institutions will get benefits in terms of getting exempt income, from of the charitable trust where they are part of. The financial sector benefits are also quite a few of them have been introduced. And then there's a clarification on the equalization levy. All these measures, if we look at, they create an environment for investment. And if one looks at it, the government has brought in such things over a period of time: the 15% tax rate, the 22% tax rate for companies, then the different other measures. So that brings in changing from dividend distribution tax to the taxation of dividends. All these are measured to promote investment and especially bring in foreign investment. On the one hand, we are talking about Atmanirbhar Bharat, where the Indian industry is required to grow, but then after a while we require foreign investments to come in, so that India becomes a manufacturing hub of the world, like some of our neighbors have developed themselves into, or the larger countries in Asia Pacific region have developed into. So those measures are there. Then on the minimum burden on taxpayers, we are seeing relief to the senior citizens, 75 plus persons. And most of us probably have people in the family who will be getting this benefit. We'll have to see how much real benefit is coming in. Then we have got the pre-filled forms, income tax returns, so which will, since the life will become easier, there will be larger compliances, and we have seen the growing number of taxpayers as well as the growing number of tax filers who are filing their tax returns. Well, one of the biggest surprise for most of the people was that there was no increase in taxes in spite of the COVID pandemic. So if you see that everybody was looking at a COVID cess coming in for on the direct tax front, whether it's for companies or for individuals, but that did not materialize. So therefore, even with a 9.5% fiscal deficit, the government did not introduce that. And if you look at on the indirect tax side, the cess on commodities which have been introduced, there's no real hit on the consumers because of the reduction of the base rates. There will not be a hit on the consumer side of it. Then there are the retirement benefits. Many of the NRIs who have come back to India after spending their working life overseas, they were affected by the mismatch of the taxation of the retirement benefits and the pensions overseas with the Indian tax system. So therefore that has been cleared. And another thing which is this tax audit threshold increase has been increased for the smaller the MSME sector. So that is something also which will be big beneficial and make it much more easier to do business in India. So these are the 4 pillars that I see and that we have noticed when in the tax proposals that have been brought in. And one of the things that one needs to also understand that these are not one-off cases. These are in a continuing process which the government has, or a continuing initiative which the government has embarked upon. So that is something which is making these proposals are coming in one after the other. So then we may see more things like this, in the future. But as of now, though the number is small, but in this budget, that has been introduced. Another trend that we are seeing is that like the GST, we see changes happening throughout the year in the direct tax side also. Especially post the pandemic, we have seen a lot of measures have been introduced, and a lot of amendments have been introduced. So that is something which amendments are also are now getting enacted, but through ordinances and notifications, various measures have been introduced. So therefore, direct tax also, that's the other trend which is coming in, that is becoming much more, over a period of throughout the year. That is something which is coming into the system. It's not merely the budget which used to be earlier. So that's the other trend which is coming in. Well, if we look at the tax policy announcements, ease of compliance burden, as I said, that for people above 75 years, they are not required to file the income tax return if the income is consists of only pension and interest, and then there's a TDS which is done. But once you read the this is a very good measure, but once you read the fine print, there is a provision of TDS which has been introduced. So the senior citizen has to determine the entire income, has to give a declaration, including claiming all these Chapter 6A deductions, etc. Give it to the bank, and the bank will, on that basis, will do the without deduction of tax at source (TDS), and then only you do not need to file the ITR. So if we compare to a situation where somebody has to file the ITR, I think effectively that doesn't lead to much of a benefit from the practical side of it, because if there are 3 banks that a person has deposits in, then that creates a confusion, and then he has to go. If the person has to go to the 3 banks to get all the TDS effect, TDS impact to be done and to be cleared. And in practice, also what we have seen is that the banks do not necessarily do a proper TDS, and there is no coordination between different branches of the same bank also. So therefore, there can be a bigger challenge if somebody wants to follow. So probably at the practical level, there needs to be some more fine-tuning of this law to make it more effective. Then we have got the tax audit, and this is again a big thrust on the digital transactions. So if you have more than 95% of digital transactions and not cash payments and cash receipts, then the tax audit, rather requirement of an audit is increased. The threshold is increased from 5 crore to 10 crore. So that's a substantial relief for the businessman, but then can be a dampener for the practicing chartered accountants. So that is something which is probably that's the darker side of it. For small taxpayers, there's something called the Dispute Resolution Committee, which is coming up. That if your returned income is less than rupees 50 lakh, and then the variation proposed is less than 10 lakh, then the taxpayer can go to the Dispute Resolution Committee and can get this resolved, from where there will not be any further appeal by either side. So that is something which is a good measure. Well, as we all know that, at the policy level, what we have seen that, at the highest level, the government actions are very, good forward thinking, and they take a lot of try to give a lot of benefit to the taxpayer. But at the end of the day, we had something similar, which was the DRP, the dispute resolution panel, which was introduced some years back to the with the for the large taxpayers, especially initially that was for the transfer pricing adjustments, and then later on that got expanded. But then this that never took off really, because it was that, and that was a problem for both sides. While it was a dispute resolution panel, more something like a settlement, but the attitude of the taxpayers as well as the attitude of the revenue was they were all was more to use it as an extended mechanism for appeals. And once the appeal the right of appeal by the revenue was taken away, hardly any benefits came in. The only thing was that you could go to the tribunal much faster, and you could get that collection of the demand in abeyance for some more time. But other than that, the dispute resolution panel did not succeed. So therefore, here is also something where if the dispute resolution committee will be successful or not is the other question. Is the other question which will be there. One has to see over a period of time, and the proper implementation of this from the revenue side will also be important to make it a success. Again, the reduction in the time for reassessment from 6 years to 3 years, this is something which is very good, because after a very long time, if something like that comes up, it makes life difficult for the taxpayer, even for the tax authority, revenue authorities also. And and this gives a lot of certainty. After 3 years, there will not be any reassessment unless there is an evasion. And as many of us have seen that overseas investors, people who invest into India from overseas, when they hear that your tax position can be reopened for up to 6 years, or the 7 years from the year of transaction, you just see some sort of a resistance on that front. But what also what makes it more important in this case is that, mind you, these chances of reassessment with the faceless assessment process will be lesser. So therefore, we may see much more disallowances and much more wider coverage, in the assessment process, which will be covered under this mechanism, and that's coming under the efficiency pillar. As we can all see. Now, the thing is that so this gives a lot of food for thought for corporates and businessmen, that that the strategy to be taken, the preparedness to be there, the in time preparedness for the assessments, how to take things forward. So that is something which will be very important, because once you have gone through the assessment, and you have not done your proper planning and proper presentations over there, the proper presentation of the facts, then you may end up in a larger litigation, or in a and it can be a permanent loss for the taxpayer if things are not done well. So that is something, probably some professional help will also be important. Then the tax settlement framework is getting amended. Now, this tax first is the advanced ruling authority will be replaced by a board of advanced ruling. So this is something is something which I do not know. I personally couldn't find much of a reason for this, in the sense that to put two principal chief commissioner rank officers in the advanced ruling board to be to man the advanced ruling board I do not know how much of an independent way of thinking will be brought in over there, and what benefit can the taxpayer really derive out of it, because quite a lot of quite a lot of decisions and rulings which helped the taxpayers in an advanced ruling authority mechanism will go away. And the other thing which is there is, which is absolutely against the case of certainty is, is that it is the order of the board will be appealable, by both the taxpayer or by the taxpayer as well as by the revenue. So it will be a, rather than board for advanced ruling, it will be for advanced litigation. I mean, something for advanced litigation probably, which it may turn out to be. But one has to see. No doubt, AAR rulings were also under challenge from both sides, but only on a very restricted basis in a writ where the jurisdiction issue was the main point. But here there can be no end to it. We need to see, how it is advancing of the litigation process from before the ruling itself. So one has to see how this will pan out. The other one is the settlement commission, which is getting closed. So there can be some genesis to this. So we need to see that the pending cases will be moved to the interim board. Faceless income tax appellate tribunal, as I had mentioned before, that there will be a new scheme which will be coming in. And this is to bring in, efficiency as well as transparency in the tax mechanism, tax authority mechanism. So therefore, the appellate tribunal will be there, but one needs to see that, how an appeal can be argued before the tribunal. And one of the key things is that the hearing will be optional if required. So therefore, that is something which will make. One has to see how that pans out, because the right of hearing in an appeal is something which is guaranteed under the Constitution also. One needs to look at that, how the hearing thing happens. So one would need to see how this pans out also. And the other point which I made earlier was that how's the department going to cope up with this additional work is also some factor which one needs to look at. So one would have to read the fine print on the scheme which will come out. So then only one would have to see. This is an announcement as of now. So one would have to wait for some more time to see the how this one will be. But in a case, this increases the opportunity for the professionals also, because like the online hearings which have opened up the opportunities, that that something that we call geography is history, where you are based is no longer important. What you can work on is more important. So it's something called a geography is history. This is not my coinage. I have heard it from my very young professional days, coined by somebody else. I do not know who coined it, but this is something which is something great that one needs to that one needs to see how it will pan out. Well, corporate tax rates, there are no changes. As I mentioned, I won't spend much time on that. So the manufacturing companies continue to be at 17.16, 15% plus, and the other domestic companies continue to be at 25.17, 22% plus. So therefore, and foreign companies, that way one can see that the LLPs and firms are at a disadvantage. But mind you, the LLPs and firms' profits are exempt in the hands of the partners. But in the case of companies, there's an additional tax which is imposed on the dividend. Earlier it used to be DDT. So that is something which remains unchanged here. This is something which is for corporate restructuring. There'll be a lot of heartburn for the taxpayers, as well as for the consultants. As we all know that some years back the Supreme Court had decided in the case of Smith Securities that goodwill is an asset on which depreciation was allowable under the Income Tax Act, under Section 32. Now, based on that, both purchased goodwill as well as goodwill generated, in course of amalgamation, have been, claimed depreciation on such goodwill has been claimed, and there has been dispute. But generally, what happened was that the revenue was accepting in many jurisdictions and the allowability of depreciation on goodwill, because after the first stage of appealing, there are many cases where we have where there were proper facts, etc., where we have also I have the experience of handling such matters. Milan case was one of the biggest example, which is a reported decision that we have seen, where it has been allowed at the ITAT level, and in many other cases it has been allowed at the even at the first appellate level of CIT appeals. That is there, but that whether you may call it a loophole or whether you may call it a change of approach, this is now getting plugged, and depreciation on goodwill will no longer be applicable. This is applicable from assessment year 21 22, and there are further adjustments which have been mentioned in the purchase price, in case where depreciation, there's a sale of business or different other cases over there. So therefore, one big benefit of a restructuring goes off in this, and in many large with corporate mergers and other transactions, there were huge goodwill which got generated, and that in many cases have even reduced the effective tax rate of companies. That will now go away. The other thing which is there is, this is something which there was an interpretation issue which has now been I would say that has now been killed really by by this amendment, is that in a case of slump sale, we were taking a position that it only covers sale and not other modes of transfer. So therefore, the slump sale could not be brought to tax. Something which even for slump sale itself, that was there at one point in time, and then the law was amended. But now even other forms of transfer are also included, like in case of a slump exchange also, like for sale of undertaking against issue of shares or and other these types of transactions will also get covered and taxed in the process. Yeah, and the other mechanism which has come in is that in case of any reconstitution or dissolution of partnerships or AOPs, this in this case this will be again will become taxable. There is a section which has been introduced in the law for this section. Subsection 445, subsection 4 and 4A to section 45, which have been introduced, and so as a result, and that will be another case which may probably negatively affect partnership firms, and where which also is a negative impact on the MSME sector. So that is something where many of these businesses are carried on in the MSME in partnerships. So that is something which will one needs to take a look at it, and there can be proper planning in genuine cases where there will not be that it can be planned, but one has to see how that comes in. There are a few issues which need to be addressed in this case. That is something which will be one has to look at. And then there are extension of tax holidays. Now startups, they were getting tax holiday under section 80 IAC for new startups, the startup entities which were for 3 years out of the first 10 years of their operations after being set up, and the profits were exempt from tax. There's a tax holiday. But then you had to commence your operations by 31st March of 2021, which has now been extended by 1 more year, and to 31st March 2022. Similarly, if somebody sold his property to join to invest in a startup, then that also would have is exempt currently. But then that again the transfer is for investments made up to 31st of March of 2022, it will now be exempt. I have only one point against it. This is a very good measure which will give the benefit, and 3 years out of 10 years, I think probably towards the end of the 10-year period, if a startup makes profit, then that is something which is there, which gives a flexibility. But having said that, May I request other participants to kindly put your speaker on mute? We have to see that I mean it gives a flexibility and also which is there. But having said that, the one point which comes in is that these extensions on a 1 year basis, do not really give the proper benefit to the intended sectors. I mean, this can be extended by a longer term because a planning process takes much more time, or decision making takes much more time. So therefore, if this can be extended for say 3 years at a time, then that gives a better window for people to think through and invest over there. And the other point which is there's a major roadblock for startups is funding. So on the funding front, I think some more actions could be taken, because if you fail, because of funding, there are many startups which do not see the light of the day because of the funding issues, and the banks process, they don't really give loans to the startups, or the processes and the paperwork which is humongous in such cases. That is something which one has to think through and imagine that how that can be taken care of, because startups, even unicorns do not make profit for very long years. Amazon, which was a startup at one point in time, probably had seen the profitable thing, the profitable P&L account much later in its life. And there are many other unicorns in India also which have not yet seen the the profitable days. So therefore, more than the startup holiday, the tax holiday, I think funding could be a better mechanism to help the startup sector, which has got a lot of potential, especially in a country with a young population like India. In the affordable housing, again, the housing projects, the smaller housing projects of 1,000 square feet in metros and 2,000 square feet in less than 2,000 square feet in smaller locations. There could be, there's a tax holiday which is 10-year tax holiday which is available. So under Section 80 IBA, that has now got extended. But again, this is the projects have to be notified by 31st of March of 2022. One new thing which has come in is that something called the rental housing project. That is something which is this is a good well thought out measure, because there's a lot of property which are not getting sold, and smaller flats which for especially for people who are at various levels of of the society, who are we see a lot of migrant population within India. And on the one hand, the builders are being taxed on property, unsold property, on the rental income. So therefore, this is something a benefit which is there. The projects have to be notified, but then there will be notification, and one has to see that this notification happens within 31st March of 2022. So there, this could be, and when we are seeing that the fiscal deficit is not likely to come down in the next 3-4 years, so therefore the economic revival will take some time. So that being so, this 2022 could have been extended. I would believe that it will be done on a year-to-year basis, but that gives a lot more certainty for the, if you make it for 3 years at least. That's something which is there. And then the interest income under Section 80 EEA, that also there's an additional deduction of 1.5 lakhs which has been there for sanctioning of loans. In all the three, I think the timeline, the extended timeline probably could be done a little, more. That is something which is there. Otherwise, these are good measures, and should give a fillip to the housing sector, which is just looking at growth in the demand in the residential sector. So therefore, that's a good measure. Well, on the business expenditure, this is something which is business expenditure front. These are things which are more clarificatory, like employee contribution to any labor welfare fund will never be allowed if you don't pay on time. So we had disputes on this, and post amendment of Section 43B, where this has now been, and there have been rulings in favor or against also, that that does not cover the employee contribution, because 43B is only for the employer's contribution. So that puts us in a bit of a dichotomous situation, that if you do not pay the employee contribution on time, you never get a deduction, whereas an employer contribution is within the filing of the return. If you do, you get it in the same year itself. Now there is a underlying reason for that. See, at the end of the day, the employee contribution is a fund held in trust. So therefore, the employer has the responsibility not to use that money for anything else, but to put in the government, with the retirement funds. So that is something which is there, and that is probably has a good social idea behind it. That will be there, and to make the employer much more fleet-footed on this issue. The presumptive taxation, with the growth of LLPs, that has been now taken out. It's meant only for the MSMEs, which are there. So it will be applicable for individuals, HUFs, or partnership firms. So presumptive taxation is generally to step back a little. If you have income which is this is Section 44 ADA, low income, partnerships. If you 50% of that is treated as the profit, 50% of your receipt up to 50 lakhs. I mean, companies having, individuals or HUFs and partnership firms having turnover up to 50 lakhs of rupees in a year. 50% is treated as expense, and on the balance, 50% taxes are to be paid. So that will not cover LLPs henceforth. Earlier it was covering LLPs. So that will be out of that. So when LLPs have to do their proper accounting to pay the taxes. Well, then again, liable to tax has been extended. So this is a benefit, and this will help in in cases where somebody in the UAE, which does not have taxes, but there's an exemption which is there. In such cases also, the liable to tax, the benefit will be there. So that is something which is a benefit, and this has been upheld by the Supreme Court also earlier in Azadi Bachao. This principle in a similar form has been upheld before, so that comes in the law. That's something which is very good. Well, on dividend taxation, this is there are quite a few good things that have happened. One is that the dividend paid to this real estate investment trusts or infrastructure investment trusts are exempt from TDS. Actually, these trusts are pass-through entities, like as per for tax for here. Now, there was no clarity on whether TDS has to be done. So therefore, a lot of leakage used to happen, cash flow issues used to happen. But then, once they have been made from the last year, they were made pass through. So the TDS has also been, retrospectively amended, the TDS provision, so that when the companies pay the dividend to the REIT or the investment trust, then they do not have to pay. There's no need to have the TDS on that. So that the entire amount can be paid. So this is a good move, and will help in the return on investment on the infrastructure sector or the real estate sector. The lower tax treaty rate applicable for TDS on FIP's income, that is also something which is there. This is the arising from the PILCOM issue, where the court had held that for the TDS purposes, the lower rate treaty rate will not apply. So that has now again been amended, has now been amended in the law. So that is something which will benefit the foreign investors, so that the TDS can be lower. And then advanced tax. This is also something, we have a similar thing in case of, the last item, which is advanced tax upon dividend income, where we have a similar thing for capital gains, that once you get the income, then only you pay the advanced tax on that. So that will also apply. So you do not have to pay interest for default in the earlier installments during the year. So that is something which is also again a good beneficial move, and it gives a lot of clarity on the subject. Well, because of the prices of properties are down in the pandemic, so the deemed income on sale of property, of sale of residential units by property developers is there is a safe harbor percentage which was allowed to 110%. Now that has been increased to 20%. So if your rate or the value determined is even less than the circle rate value, the stamp duty value, which is by 20%, for a particular transfer undertaken during a particular period, 12th November to June 30, 12th November of 20 to June 30 of 2021, and then and for certain particular properties of a value which does not exceed 2 crore, the rupees 2 crore, then you can get the 20% additional benefit. 10% remains in other cases. Similar, consequential, there is a another provision under 56.210. There's a deemed gift provision. Income which arises from gifts. That is also something which will apply. So therefore, there will be a consequential relief for the buyer also. So this is good, and should help in sale of low cost housing and smaller housing. So that is some affordable housing. So therefore, that is something which is a good move. And but this up to June 30, 2021, probably this date will get extended over a period of time. Otherwise, that may not give the intended benefit to the fullest extent. Well, this is one thing which is will bring in a lot of smile on the face of the companies, the large who are into large purchase and sale of goods, and this will bring in a lot of smile, because last year it was a humongous task to bring in the TCS provision. Companies spent hell of a lot of time, energy, money on on the ERP systems, etc. in introducing the tax collection at source. The sellers had to, the large cases of sales above 50 lakhs, they had to implement that 206C1H, which was there. So in such case, now going forward, there will, from 1st July of 2021 this year, there will not be any more TCS required. In such cases, there's a new section 194Q which has been introduced, and where the responsibility will be on the buyer to do the TDS on goods sale, which will be there at will be done at 0.1%, the same percentage which is there, except for where there is no PAN of the seller, which is unlikely. Tax will have to be deducted at 5%, but otherwise it will be at 1%. So this is I would think is a much better way of collecting tax than the TCS which was introduced, and becomes a much more ease of doing business, which is there. Many of our friends in the tax fraternity spent sleepless nights last year at the introduction of the TCS. Now it's a good news probably for them. There'll be some more spending by the buyers to implement their ERP systems. Well, these are the measures to penalize persons not having income from not having their PAN or not having proper tax filings, not doing their tax filing. So these are where the rate of TDS or TCS will go up. Somebody who has not filed the tax return in the last 2 years, will be required to deduct TDS, will be subject to higher rate of TDS, which is 5%, or the twice the rate of the current tax TDS rate, which is applicable, whether under the domestic law or under the treaty. So that is something which is there. There can be an issue here that whether double the rate of the treaty will apply or not. That is, when the government has agreed not to deduct tax at a larger rate, that is something which will be there. But anyhow, the 5% rate applies. And here also, probably that's a lacuna in the law which is there, which would will have to be taken care of, like senior citizens above 75 years age who do not file returns for 2 years, who will not be filing returns for 2 years, whether they will come under this route or not is the other question also which will be there. Probably that is a mere draftsman error. That is something which will be taken care of. Well, this does not apply to salary and other cases, and where it is not really practical to apply in those cases. So that has been taken out. Now this is the one which I'll not spend much time on. That the dates have been all brought forward. Now you find the tax return to be can be revised in case of those who file in November within 1 month. So that's the taxpayers' efficiency which the government is looking at. That you have to implement that. And you have your initial return itself has to be right. There's no point in going ahead and doing a revised return at the later stage. That is something which the government is trying to do. That if you have to make any claim, do it in the first return itself. Don't wait for the second return, or and you should not have errors and omissions in your original return itself. Well, this is something is for the MSMEs and the startups, for the small businesses. The things which have been done. There's a huge investment which will come, 15,000. It's a doubling of the allocation by the Ministry of Micro, Small and Medium Enterprises. 15,700 crore for the year, which is the government will spend on the MSME sector, which got hugely affected over the past few years due to various measures, and the pandemic has also created a huge problem. For Atmanirbhar Bharat and helping these companies, the customs duties on various goods have been increased, protection. So for the indigenous push. The bad debt resolution framework for MSMEs to be made by the government. So ease of doing business, to decriminalize the LLP Act. This is one big thing, and will make the LLP bigger success, and it will be much easier for the smaller businesses to operate under the LLP Act, because they had a lot of issues with the LLP system. Faceless dispute resolution. And the government to increase the threshold for tax audit. So quite a few of the measures which have been within the limited number of measures which have been introduced in this budget. There are quite a few and quite effective measures which have been done for the MSME support. And for startups also, initially these are all initial stages. They are also in a way, though technically we may not call them the MSME sector, but these are also in some way can be called under the small businesses. The one-man company, tax holiday extension, capital gains extension. So these are moves. These are measures which will be definitely very good to good to see for the indigenous industry to grow. And hope the implementations, there are no roadblocks, which hopefully there should not be, and the taxpayer also and the business should be able to take the benefit of that. Well, on the personal tax front, I will there are no changes in the tax rates, but the one dampening thing which is there is that the provident fund contribution is something which is above 2,50,000. Any interest on that contribution will be taxable. Implementation of this will be a humongous task for the employer or the fund. That is something which will be there, and the tax, this is the salaried class is a favorite hunting ground for collection of taxes. So therefore, this will be hugely affecting the salaried class, and not sure whether senior citizens deserve this. But over a period of over the years, I mean, not only today or yesterday, but it's over several years now. Probably the last 10 years we have seen slowly, from the exempt mechanism that has been brought down to the taxability has been introduced for the retirement benefits, and ULIPs have been brought at par with mutual funds and mutual funds. So that is something which is there, that contribute in annual premium exceeding 250,000 will no longer be benefited. The returns will not be exempt for for under section 1010D. That will not be there. And the retirement benefit, the mismatch which used to happen, that is also something which is to the rules to be prescribed. That's a good move for the senior citizens. Ladies and gentlemen, with that, I will pass on to Abhishekta for introducing Pulak and over to the indirect tax proposals. Thank you very much for your patient listening.
Thank you so much, Mr. Mukherjee. Thank you for your nice deliberation. So after this, we will directly go to our presentation on indirect tax. After that, we will take the question answer session. So we would request the participants to write your questions in the chat box, please. May I now request Mr. Pulak Shah, Chartered Accountant, to deliver the address on income tax analysis and share your presentation, please. Sharbani, I'm just showing the speaker presentation slide. So Mr. Shah is a chartered accountant and a cost accountant by qualification, having more than 26 years experience in various indirect taxes, including GST and VAT. He is a former president of the Association of Corporate Advisors and Executives, Kolkata, a member of Direct Taxes Professionals Association, Kolkata. He is a regular speaker on GST, service tax, VAT, etc. in various professional forums all over India. Over to you, Mr. Shah. May I request you to share your presentation?
Sir, the sharing rights will be passed on you. Sir, can you share the presentation?
Yeah, I'm sharing.
Okay, okay.
My screen is visible now?
Yes, it's visible.
Good morning, everyone.
Good morning.
As you know that when yesterday the budget was about to be placed, we were in discussion whether there would be any COVID cess or etc. to be levied on any transactions as far as the indirect tax is concerned. But fortunately, that kind of no COVID cess has been levied for any indirect tax transactions. But there is one important thing which has come up into that agricultural infrastructure and development says that agricultural and infrastructure, that is called AIDC, which is to be levied on certain items and under customs, as well as certain items like mainly into the petrol and diesel in respect of the excise duty, in regard to the excise duty on petrol and diesel. But what we have seen that when we have read the fine print, we have seen that this AIDC, which has been levied on a certain category of products at the time of its import, and there are reduction into the basic customs duty on that particular item. So basically, it is offsetting the duty at the time of import stage, so there would not be a much burden on in the hands of the customer. And similarly, in the case of excise duty, when that excise, that AIDC has been levied on 2.5 rupees on petrol per liter and 4 rupees per liter of diesel. but it is not actually impacting to the customer as a whole, and to offset this additional charge, the basic excise duty has been reduced to that extent, so there would not be much impact for this AIDC. And this AIDC, the purpose of this AIDC is that it will be used only for the purpose of improvement of the agriculture infrastructure and other developmental expenditure. In customs front, there are 400 old exemptions now has been proposed to be reviewed, and it would be a revised customs duty structure to be issued by October 2021. Another important amendments which have been brought in, that all existing conditional exemptions under the Customs Act would be effective till 31st March 2023. So after 31st March 2023, all existing conditional exemption notifications under customs will not be effective. Further, going forward, when any conditional exemption notifications under customs to be notified, that would be valid till 31st March, falling immediately 2 years after the date of such grant. There is one more important amendments which have been brought in, that now there has been that accountability has been brought in for the officers during the course of that any investigation and etc. under the customs. Earlier, what we have seen that when there is any investigation has been initiated, we see that there is a number of years are going on, people are following up, and the show cause notice finally getting issued after 3 years, 4 years or something like that. Now there has been a clear-cut accountability has been placed, and the time limit has been given at the 2 years time. Within 2 years, a show cause notice is to be issued, and these 2 years can be extended for up to 1 more years with the prior approval of the principal commissioner or principal commissioner and the commissioner. However, this time limit condition shall not be applicable in a situation where the investigation has been initiated before this bill gets the presidential assent. There has been another important amendment in regard to filing of the bill of entry. As we all know that earlier that bill of entry was to be filed before the end of the next day when that particular goods reaches to the customs border. But now it has been changed, and now there would be a mandatory filing of the bill of entry in advance. Mandatory filing of the bill of entry in advance, that means advance bill of entry to be filed before the end of the day preceding to the day of arrival of the goods, including holiday. That means even if it is an holiday, this mandatory filing of bill of entry in advance is required to be done. There is, just like in the GST portal, there is a common customs electronic portal is to be notified, which will ensure that there would be carry out the cross-border trade in terms of the filing of the documents, amendments, payment, duty, order, summons, notice, etc. It is just like the way we are already used to under the customs, under the GST. There are certain, to keep it in mind, that Make in India scheme, couple of items which are being imported where the customs duty rate has been increased, and so that the goods can be manufactured in India, and so that the Make in India scheme can be successful. And also there is a discussion and there is a proposal that the government will introduce a phased manufacturing plan for manufacture of the solar cell and panels in India, so that the India can become an independent manufacturing facility, and so that they can boost up the local manufacturer. Another important thing, as you all are aware, that today in India we are going through a high-speed railway projects, various high-speed railway projects, and these high-speed railway projects now being included into the list of projects
to which the project import scheme is applicable. There are project import schemes are applicable in case of in a customs. We have seen that project import scheme, and this high speed railway projects are now being incorporated into the project import scheme. And for that matter, National High Speed Railway Corporation Limited has been nominated as the sponsoring agency, and they will approve the items which are required to be imported for the purpose of these high speed railway projects. Under GST, there are a couple of changes under the CGST Act, and the most important amendments which have been brought in, the first thing is that now the matching concept, as we all know that when the GST was about to be implemented, that time that concept of matching concept which was actually brought into the GST, however, it could not actually been effectively followed and effectively been implemented because that the system and infrastructure has not yet been built up to get the right desired result. And for that matter, that matching concept was not being fully implemented. Now it is categorically stated that input tax credit will be available in respect of only the invoices which has been uploaded by the supplier. That means if any of the suppliers of you who does not upload the invoice, then you are denied the credit, and this will actually cost upon the business to take a effective control over the the supplier, that whether the suppliers are actually filing the return and uploading the invoices or not. If the vendor does not, if the vendor is not uploading the invoices, then you would be denied the credit. So there is a clear cut, and definitely whether that is a correct law or not, that is the court will be deciding whether any credit can be because of the fault of the vendor. When I have received the material, I have paid the tax, I have paid the money, whether my legitimate credit can be denied or not, that the court will decide in this regard. But however, the present position of law that you have to take care of your vendors and to ensure the vendors are doing the proper compliances. Another important relief has come up, as you all know, that at the end of every year, that 31st December of the following year, that GSTR 9 and 9C. GSTR 9 is the annual return, and GSTR 9C is for getting your accounts audited by a chartered accountant or a cost accountant. That is what we call a GST audit. Now this has been scrapped, and now that GSTR 9C is not required to be audited by a chartered accountant or a cost accountant. It would be done by it would be a self-certification process, and it would be a forming part of the annual return, and it would be self-certified by the company itself. And in effect, what is happening, that there would be more enforcement on the company. That means when the company is self-certifying, that he is now taking the entire responsibility. Earlier, that responsibility was shifting to the GST auditors. Now the GST auditors, there would be no GST audit, so the entire responsibility now cast upon the SAC. Now there has been a wide power has been provided to the department and the authorities to call for any information from any person relating to any matter dealt under the GST Act. The wide power given to the department and the authority, this is nothing but that reinforcing the government's stand that government will stop the fraudulent activity in the GST ecosystem. Now penalty has been increased. Penalty has been increased from 100% to 200% in relation to the transportation and storage of any taxable goods in contravention of the provisions of the GST Act. And in case of this penalty, if you do not agree with this penalty, and if you want to file an appeal or in regard to this imposition of penalty, then you have to pay 25% of the penalty as pre-deposit. However, if your goods are not a taxable goods and it is an exempted goods, then you can make a payment of 2% of the value of the goods, or 25,000 rupees, whichever is less as penalty, in a situation when the assessee comes forward and wants to make the payment. Again, there has been a retrospective amendment by reversing the decision of the Supreme Court in the case of Calcutta Club Limited's case in Supreme Court, wherein that concept of mutuality was established, and concept of mutuality was established by the Supreme Court, wherein it is stated that the club is for the members and club and members are not distinct person. Club is club and members and one and only person. So any service provided by the club to its member cannot be taxable under service tax. Earlier, GST, VAT, and also the Supreme Court, and the similar principle was applicable in case of GST as well. Now there has been a retrospective amendment, and by this retrospective amendment, now it is stated that club and association and its member or constituents shall be deemed to be two separate persons. So by deeming fiction, now club and its members are two separate persons. Once by deeming fiction, club and members are two different persons. So any transaction, any supply between two different persons shall be liable to GST. So that has been taken care of with retrospective amendment. And with this, what the clubs were thinking that they are going to adopt, that the Supreme Court decision in Calcutta Club's case is no longer valid. Section 50 has been amended with, again, it is retrospectively, but this is for the benefit of the assessee, that again it has been stated that the interest to be paid on the net cash liability at the time of filing of the return, if the return is filed at a later date. Another important amendment which has been brought in section 83 subsection 1, wherein that that section 83 subsection 1, it was a power given to the authority that during the pendency of any proceedings, even at the investigation and proceedings, if it is in the mind of the authority that there could be a loss of revenue, they have the power to attach any property, including bank account and etc. Now what has happened now, there were specific sections earlier, that sections were section 62, section 63, 67, 73, 74, etc. Now the law has been amended, and the new subsection 1 has been substituted, wherein it is stated that after initiation of the proceeding, earlier it was where during the pendency of the proceeding. Now it is after initiation any proceedings, and here there is no specific section. Here the chapter 12, chapter 14, and chapter 15. Chapter 12 deals with assessment, chapter 14 deals with inspection, search, seizure, and arrest, and chapter 15 deals with demand and recovery. So this is another important amendment which has been brought in. Now another important, as far as the supply to the SEZ, supply to the SEZ shall be considered to be zero rated only and only when it is provided for the purpose of any authorized operations, because unless until it is for authorized operation, for this purpose separate procedures are to be followed to ensure that supply made to SEZ for authorized operation, if you cannot satisfy that it is for the purpose of authorized operation, that means it will not be considered to be a zero rated supply and tax to be paid on that. Now there are a couple of stringent provisions have been brought in respect of refund in case of export of goods by paying of duty. Now, this refund of IGST refund of IGST which has been paid in respect of export. Earlier, anybody, any item could have been exported, anybody and any item could have been exported, and the refund application could be filed. But now the government is going to notify the class of taxpayer. That means there would be a class of taxpayers who can export and ask for the refund. Government will notify the class of goods and services which can be exported with payment of duty and ask for the refund. So there is a there would be a class of taxpayer and class of goods and services which would be notified. Now the blanket export would not be available for refund of IGST paid. If during the course of refund process, refund has been allowed and it has been subsequently detected that the tax credit has been taken by way of fraudulent utilization of the input tax credit and discharging the duty with that fraudulent credit, then the penalty would be equivalent to 5 times of the refund claim. So there is a stringent penal provisions. So anybody before filing a refund application has to be clear that there has not been any fraudulent utilization of any credit. Another important that when an export has been made with payment of duty, now it has been because when we file that refund application, automatically the refund we get, but there is a 6 months timeline under FEMA that I have to bring in the money into India in convertible foreign exchange. In case any non-realization, suppose I could not realize the money within the timeline given under FEMA, subject to certain date of extension as provided by the Reserve Bank of India, that in that case the refund which I have taken, I have to pay back along with interest. The first time they have brought in that it has been linked with the realization of the export process. So with this, I conclude my presentation. Now I leave it to Avishikta.
Thank you so much. Can we take some questions, Mr. Mukherjee? Should we take the questions now?
Or should we do it after the panel?
Okay, okay.
Then the panel will also be available for answering if there are questions.
Okay, right. So now then we will have our panel discussion moderated by Mr. Kaushik Mukherjee. We have our distinguished panelists, Mr. P.P. Gupta, MD, Techno Electric and Engineering Company Limited, Mr. Arun Ramachandran, Head of Taxation, Tata Consumer Products Limited, Mr. Prashant Khemka, Founder and MD, White Oak Capital Management, Mr. Naresh Pachisia, Founder and MD, SKP Securities Limited, and Mr. Kuntal Kumar Sen, Tax Policy Specialist and Past Commissioner Income Tax, Government of India. May I now request Mr. Kaushik Mukherjee to start the panel discussion.
Yeah, thank you. And I would welcome Mr. Gupta, Arun, Mr. Pachisia, Mr. Prashant, and Mr. Kuntal Sen, to this panel. Be there, and special thanks to Mr. Khemka for joining from Singapore, and also to Mr. Sen for coming all the way from Mumbai to join us for this one, and also to Arun. In spite of your busy schedule, Mr. Gupta, thank you very much for making time this time for the session. And Mr. Pachisia, we have been presenting together for several years now, and it's always a pleasure to have you in the panel for your well thought out speeches. Thanks to all for making time and joining. Abhishekta, can you please put your mic on mute? And we are.
Mine is mute only.
Oh, okay. Sorry. And there. So I have a I will start with my first question to Mr. Gupta. Sir, may I request the panelists to put their camera on? I think that'd be great. Yeah. So my first question is to Mr. Gupta, that this budget proposes a framework which is enabling the electricity consumers to choose between service providers in electricity distribution. So how do you, see this change impacting the existing DISCOM companies, and how it will help creating opportunity to new entrants in the DISCOM segment?
Yeah, absolutely. It's a very path-breaking budget as far as power sector is concerned. The intent is very strong behind it to reform this sector. We created Electricity Act in 2003. The very spirit of the act was to reform this sector to the market reforms, which never happened in this sector, unfortunately. We have achieved so much otherwise in power sector that we almost have 1.5 times the generating capacity. We have a very strong transmission links, but somehow distribution remains by and large a monopoly, as admitted by FM, also in the last budget speech yesterday, and is inefficient and retrograde. So the consumers continue to be denied many benefits which they should have got otherwise, as they got in other sectors like highways or telecom or ports. But no market reforms actually, in true sense, reach to the consumer. So that way, it's a very huge statement, I will say, that the consumer will have a choice of the supplier of power to them or electricity to them. It's a huge intent behind the budget, but I doubt whether it will really become a reality. You see, that was the basic requirement of the act. Two things were there. One was the open access, another was the choice of service provider to the consumer. So that in real sense, there is a competition, there is a service enhancement to the consumer, and the consumer is not merely taken for granted as if by supplying electricity of whatever quality and whatever time a distributor thinks he deemed to be served, and he becomes liable to pay, come what may. But nevertheless, 17 years post Electricity Act, reading this statement is a very huge, intense statement, very exciting, but a lot of work has to be done behind it. As a mindset, technology, innovation, many automation or many kind of present day technologies and way of doing things have to be part of life of DISCOMs. Unless all that happens, the existing bureaucratic setups cannot, deliver this intent.
So you think it will be, if it happens, it will be long term only, not that we are going to see that in the short or even medium term probably.
Absolutely, it is a medium to long term. Short term is impossible. I don't think government has this political will. Otherwise, 6 years we would not have been merely talking and not moving forward. Only we have been taking very penny steps, I will say, and creating pseudo competitions, mostly B2B, whereas consumer has been taken for granted, for whom the very Electricity Act was framed. The only person denied the service of the act is the consumer at the end of the day. So right. both issues are not in place, which were the basic requirement of this whole governing process, that there will be a regulator, it will take away the politicians and bureaucrats from the decision making. Sector will move towards market reforms. But let me speak out from my heart, I don't know why this country do things so wonderfully, stupidly, many times. You see, electricity is the only commodity, and we have in abundance today. We have almost double or 1.5 times of our requirement. But still, we claim we are one nation, one grid. But this commodity has 44 prices in the country. So much is the diversity that the same commodity is priced so differentially across the country, among different states, to different types of consumers. I don't know why no government has created a political will to rationalize as a national commodity, as a very important industrial input, as a commodity for the welfare, economic development, industrial development. Unless we can provide this input at an affordable price, of a quality as desired by the manufacturer, consumers, it makes so stupid a sense that overall this sector is a drain to the whole government at the end of the day.
Yeah, I think then a lot of groundwork has to be done to make it more conducive to the consumer, to the industry, etc. So that's what I would think. In summary, that's how you would like to weigh there.
Absolutely.
Right.
You see, you cannot carry this sector forward. We created many UDA schemes, but before they could have any impact on our improvement in our life, it all became sunset. So it was never a good morning.
Thank you, Mr. Gupta. I'll now move to. I'll come back to you with other questions. But before that, let me move to Mr. Khemka. Mr. Khemka, the stock market, yesterday till at the end of the day, we saw that it was booming post the finance minister's announcements. So, your thoughts on what made the investors so happy and made them made the Sensex and the Nifty go up so heavily? You're on mute.
Yeah. First of all, thank you, Kaushik ji, for having me here on your panel. So, from the market's perspective, it was an excellent budget. I would say one of the best budgets in a long time. And the reason is just from a very high level of 30,000 feet level, if you were, the mindset behind the budget or the language of the budget, the tone of the budget was very pro-growth and was substantially in the direction of furthering the ease of doing business agenda of the government. Which has been there for last 6 years, sometimes faster, sometimes slower. If I were to specifically highlight on each of these pro-growth and ease of doing business aspect, in terms of pro-growth, you would have noticed a substantial increase in budgetary allocation towards capital expenditures, rather than increase in allocation to consumption-driven subsidies. When you spend higher amounts you allocate greater amounts to capital expenditure towards infrastructure and other productive assets, that is supportive of economic growth longer term. So that is very positive. On what I would broadly call as ease of doing business, in the ambit of ease of doing business, first and foremost, there was stability to the tax regime, continuity from the prior year. Unlike most years historically, where a lot of changes are there in the tax code, and this year in particular, given the pandemic, there were fears of increases and changes in taxes. By and large, none of that materialized. So absence of that was a big relief to the market, because there were fears of either tax increases or introduction of new taxes, which is obviously a financial burden as well as a compliance burden, and further, makes it difficult to do business. So that was one major aspect. Then there were other significant, or I would say large number of smaller items compared to the tax aspect. They might count as smaller items. Let's say the increase in FDI for insurance from 49% to 74%. It, for the first time, effectively opens the insurance market for foreign FDI. Large number of foreign companies, I would say majority of foreign companies do not want to enter if they cannot have management control. So 51% and 49% is a huge difference. So to go from 49 to 74 not only gives them management control, as well as provides obviously 74% of the economics. So that is very much, again, in the line of pro ease of doing business, would lead to job creation, as we would expect insurance companies from around the world to have greater interest in the Indian insurance sector. Similarly, or even I would say more importantly, was the measures announced or the plans announced for privatization, including several government-owned companies. And it's not just divestment, but privatization, and particularly including two of the PSU banks, which has not happened in a long time since the banks were nationalized, if I'm right, and was a very positive surprise, because if this goes successfully, then it can open the path to many more such privatizations down the line. And so execution will remain the key, but the announcements and the intent, the budget is very much in the right direction. And then there were several other changes. So Gupta talked about the proposals related to open access for electricity. That is also in the direction of ease of doing business. Then there was simplification of tax administration, where, and I don't know the specific technical terms, but the cases that are more than, earlier you can reopen, go back 6 years and reopen cases. Now that's been brought down to 3 years. Obviously, there are some exceptions and all those, but still, directionally, it's in the right direction. Then there are decriminalization of the provisions of LLP Act and so on, many others of that kind, which by and large, if you look here, the whole budget, there were many positives, lot more positives, big or small, and far fewer negatives, which is very refreshing, and in a long time, I would say that's been the case after a long time.
Right. Thank you, Mr. Khemka. I think this is something probably the market is there, and on the I'll come back to you on the insurance point a little later. I've a question to ask you on that. Before that, let me quickly ask move to Arun. And Arun, this is a tax specific question for you. Tax specific question here that I have.
Can you see me?
Yeah. You can hear me?
Yes, I can hear you. Can you hear me?
Yeah. I think. Yep. Okay. Right. Do you have two connection? By any chance?
Not sure.
One from the handphone or?
No. I just got off. I got to log in again. That's it.
Okay. No, it's okay. I mean, there is everybody else is on mute, so Or can you just log in, then I'll ask questions to someone, to Mr. Pachisia, and then.
Sure, I'll try to log
Okay,
in.
right, thanks. Yeah, Mr. Pachisia, my question would be there to to continue on the stock market. What do you think that that's the stock market has? Stock market has been booming, really booming in yesterday post the announcements. And how much does the personal tax changes? I mean, the rates have not been changed, but then the ULIPs have been brought in line with MFs. That has impacted the or even the dividend tax, etc., the advance tax on dividends. And how has that impacted the stock market?
Yeah, at the outset, thank you very much for inviting. And as you said, Kaushik, it's always a pleasure being on this panel with you every year. It's almost becoming a ritual. So Mr. Khemka has actually explained things pretty well, but still, let me put it a little differently. If we go back to a little bit of a background, how we have come to the budget yesterday. With all union budgets announced during NDA 2, they were all disappointing from the capital markets perspective. There was not much hope from budget 2021 as well. The market correction during the run-up to the budget, after a stupendous rally from the pandemic lows of March 2020 to the all-time highs of January 21, this amply validates view, the recent reaction that happened. However, the budget day rally in the markets pleasantly surprised everyone, and the reason is here. One, the budget is the most bold, path-breaking, visionary, reformist, expansionary, growth-oriented, prudent and balanced budget after 1991, which 91 budget which changed India forever. Some people place it on par with the dream budget of 1997. If we add up all that has been announced between the last budget and this budget, although corporate tax rates were slashed before that in September 2019 itself, you realize why it is actually the super dream budget. Let's compile the wish list that the industry and particularly the investors had from the finance minister. Agri reforms, done. Labor reforms, PLI in manufacturing, infrastructure spending, capital expenditure, ARC to acquire stressed assets, direct support to bond markets during crisis, particularly in the last 2-3 years, the manner in which the bond markets performed, special attention to healthcare, pandemic, particularly highlighted during pandemic, defense, textiles, etc. All to be funded without raising taxes and a stable tax regime, as Mr. Khemka just mentioned. And all this ideally to be funded by privatization of PSEs, not divestments, privatization of PSEs. It's a big shift actually, and monetization of government's huge land bank. Choice of growth over fiscal deficit, which is also lower than expected, with a long-term roadmap, transparent and realistic numbers, and of course, again, as Mr. Khemka said, ease of compliances and ease of doing business. Now, except multiple taxes on equity, that is high double tax on dividend income, long-term capital gains tax, and buyback tax, all recently introduced, the finance minister has tried to fulfill the wish list of the industry and investors, wholesomely, sort of. She has set in motion a multi-year, if not a multi-decade India growth story, emerging as the fastest growing economy in the world. No wonder the stock market has responded with almost a 21-gun salute. Everyone's focus should now be on proper execution and delivery. And as Mr. Gupta so rightly mentioned, this holds the key for the success of this budget, proper execution and timely delivery. And governments generally lack on such things. The bold manner in which we have chosen growth over fiscal deficit, ignoring the good-for-nothing global rating agencies for the first time, something that the developed economies have always done, but taught us otherwise. I think it shows the newfound confidence of India to rise amongst the league of large economies. And this has gone down very well for the markets, broadly speaking. Of course, on the debt market side, extra government borrowings will put pressure on interest rates, which I'm confident that the RBI will handle diligently, like it has been doing so very well during the pandemic. So this is my response to your market thing. As far as the tax aspect on the unit-linked insurance plans is concerned, I think it's a very nice balanced thought by the government, because ULIPs were enjoying, basically they are promoted as investment products. So are mutual funds. ULIPs were enjoying a tax-free status vis-a-vis long-term capital gains on mutual funds. They have been brought on par, except if the person, the insured, were to pass away, then it is still tax-free. So that essence of the essence of insurance has remained. So I think it's a very, very nice move, bringing both on par, mutual fund insurance, ULIPs on par, which otherwise was very, very difficult, from advisors' point of view. It was very difficult for advisors to market mutual funds vis-a-vis ULIPs.
Thank you, Mr. Pachisia. So I think that gives us a lot of insight into what's happening, and especially the personal thing. I'll come back to you with the other questions. Arun, if we move to the tax front, specific tax front, and I'll relate your question later to Mr. to Sen also. Now, you see, there are some tax policy announcements which have been made, and more and more, things are going faceless. The, assessments, then the appeals, then now the ITT is becoming faceless. There, and there will be. We may see some things more in the coming in the next 1 year or so. So, in a case of a faceless assessment or appeal, even now the tribunal thing which is coming in, it will require a lot more of effort on the part of the corporate, to file the details things over there, because what you could explain to a revenue officer at the ground level, that is no longer there. You do not know who's doing your assessment, and unless that person sees your all documents and all proper submissions, etc. So it gives a lot of additional effort, requires a lot of additional effort on the part of the corporates and the taxpayers, and especially the large corporates where the volume is huge. Right. So in such a case, how do you think the industry is geared up, and how the industry will, at such a short span of time, will be able to gear up for such things? Because faceless assessment and appeal has just come in September, and this is likely to be there from 1st of April. So therefore, right. Very soon. So what's your take on that? More sleepless nights?
Thank you, Kaushik. Thank you for having me. Can you hear me? Am I audible?
Yes. Perfect.
Firstly, I think personally it is a step in the right direction, moving towards faceless assessments, towards the faceless appeal regime is is a low touch and high tech sort of a solution which gives away to some of the concerns in the tax administration the way tax administration operates sometimes. Yes, directionally it is right. In terms of efforts involved, certainly we see a multifold increase in what it was to what it is expected to be in a faceless regime, primarily for few reasons, if I may just take a minute to point out. One, the way industries are set up in India are also in a way concentrated in a certain sections, like the automobile segment is in a particular part of the country. The tax office there are more familiar with the tax provisions related to automated automobile segment. Similarly, agriculture, similar to the company I'm working with, tea industry or coffee industry, the nuances of the tax nuances is the tax office knows a lot of these tax nuances, which would be a missing element. The industry specific knowledge, I don't expect can be achieved at least in the initial years of faceless assessment. So I expect that to be a glitch. In an appeal regime, I'm more concerned about how the councils and the senior councils who appear for the companies would sort of gear up to this. How effective an appeal would operate in a sort of an virtual environment. Of course, we've all seen that happen thanks to COVID. We've all seen that happen. So there was some element of preparedness. So yeah, overall, I see a lot of generic questions, a lot of workload increase in responding to notices, and a lot of generic questions. But overall, it's a step in the right direction.
Thank you, Arun. And now, if I may put this question, to Mr. Sen. Mr. Sen, you've been a tax policy specialist, and was with the Revenue Department for a very long time in distinguished positions. Now, as far as the assessment and appeal are concerned, it's more of a representation by the taxpayer. But when it comes to the tribunal, it is the two sides are involved: the revenue on the one side and the SSE on the other side. And if there are no hearings or it is online, then that's a completely different ball game. Now, how do you think that something which will affect the revenue functioning, or the capabilities, or what is there? So if you could throw some light based on your experience as well as your what you think about it. You're on mute, Mr. Sen.
Sorry. So thank you, Kaushik, for having over, and greetings to the other panelists and all other participants. This is going to be a challenge. Let's accept it, both for the industry as well as the department. See, the point is that this is part of a larger framework of the government's policy. And government is probably prepared to do this. I just give you, before I go into a question, so just to give you a brief sketch of how this government is proceeding over the years. Now, if you see that, which other panelists were discussing, and we all know that, first, they rationalized their tax structure, right? The tax rate structure, brought in various adjustments, some taxpayer friendly, some department friendly. And now, after having done that, with, for example, dividend taxation, buyback, it cuts across both the taxpayers as well as the department. Now they are into this, if you see from August 2020, even before this budget, they are into creating a process how to implement this to the best possible. So this now onwards, it will be all a change in the process. The policy will be geared to change in the process. And to that extent, you see that government, for all these faceless regimes, has a threefold policy. It's triggered by threefold mission for transparency, efficiency, and accountability. So it's part of a larger scheme. It's not that it's a sporadic, once in a moment thought. That's first thing. Secondly, now coming to the question now the department has I have worked in the income tax department for years. I've found that the department is very, very well equipped to rise to these challenges, mainly the digital challenges. If you step back and put the clock back, you'll see how this first permanent account number was allotted to around 5, 6, 7 crores of taxpayers. Then the entire tax accounting system was digitized. Then came this annual information returns, the matching of references. Then came the central processing center, the CPC. So all these processes have been handled, I would say, that all the limitations and challenges quite well. But this one comes with a different requirement. This faceless regime, particularly with IT. It's not only a capacity building of infrastructure, of your personnel, of your technology, but also I will call it a capacity orientation. How you take up things, right from the assessment, both for the taxpayers as well as the department, till the final stage of appeal. Now, if you see the tribunal, the key signature aspect of proceedings in the tribunal was oral hearing. all our departmental officers are geared towards that. Now, how do they again shift to this kind of a mode where they will have to do everything in writing in a very smart and efficient way? So that is going to be a challenge. And I think, department will have these orientation courses and various other capacity building, but it has to go more than capacity building to capacity orientation to live up to this challenge. Just, before, see, so far my experience with these virtual hearings has been good, but that's from the industry side. And as we all know, the industry is better equipped, right, both in terms of expertise, the workload, as well as the infrastructure facilities to deal with this. How the department does it is a matter of question, but I'm very hopeful, considering the past experiences. After the initial hiccups, things will pick. As I see, even in the virtual hearings also, the way it began initially and the way the department responded to that now, and the way they are responding to it now, there is a marked difference even in this 3-4 months. So that is how I will sum it up.
Okay, so again, it'll take a little time, but things are going to shape up, right? That's in summary. That's what you will call it, right? Thanks, Mr. Sen. I'll now move to Mr. Gupta again. Going back to the the power sector and the things which are happening. The proposals which have been given, quite a a big amount of fund which has been created for for the DISCOM companies, for them to build infrastructure. The government has allocated a large amount of for that, and then on the other side, then we are seeing that there's an increase in the solar power, the customs duty for solar inverters or solar lanterns, etc. So how do you see that for the development of the indigenous industry? How this will help I mean, developing the power sector further. We discussed about the multiple choices for the consumer, but now then there's a big fund for infrastructure development, and then solar power also is being pushed. So how do you see these two or something like the indigenous development or the indigenous development of industry in the power sector?
You see, they are excellent intents, Kaushik, as I said earlier. But to realize them in India, certain things we can be first movers or can easily catch up, but somewhere it is not possible to catch up. Like you take case of solar. You see, I think this duty rise is more because of our issues with China than because of the very solar power. Now, even if you don't import panels, you will need cells. If you don't need cells, you need wafers. And if you don't have wafers, you need glass or silicon behind it. So it's a value chain in itself. You have to accept that. Ultimately, raising duty, government is well within the power of the government. But ultimately, what will happen? It will only raise the tariffs. In one way or the other, it is a contra entry in the books of accounts of government that you pay power tariff and you collect custom duty on the other hand. But technology intervention in case of battery, I see a very positive move and a more timely move, because solar has matured so much that certain countries have acquired very dominant positions. Challenging them or changing that reality is not so easy for any other country, I will say. But battery, yes, there is a good opportunity for us to catch up. Energy storage is another area which will be a strong technology intervention in renewable power and the whole power play game altogether, I will say, going forward. The hydrogen mission is a very timely announcement by the government, I will say, because storing power based on hydrogen is a lot more easier so far as processes are known to us compared to battery storage of a grid scale size. So battery generally we are using at the moment for short-term storage, maybe 4 hours, 8 hours at best. But there are now grid-sized solutions available. But in hydrogen, it's a long-term storage. So that will be one advantage known to us. But gradually, with the battery technology going under a change, innovations and even battery solution may also become a kind of a medium storage solution to us, so that we can do away with the DG set backups, reliability needs requirements we met out of these renewable solutions, and we can be carbon free. So but I would nevertheless like to applaud our government that, as Mr. Pachisia said, as Mr. Khemka said, that definitely first time a kind of a vision or a commitment to take the country forward, make it a 5 trillion economy. It seems to be very strong intent behind it, and the tone in which it has been sent, as Mr. Khemka said, is very, very inspiring, I will say. Looks like we are going to be some force globally and achieve some parity down the line over the next 5-10 years. It seems like that.
Right. Thank you. I'll come back to you on the hydrogen energy mission a little bit, a little later. Mr. Khemka, I've a question to you on the Infrastructure Investment Trust, InvITs, and the REITs, the real estate trust things. Do you think the way the debt financing, etc., which are getting allowed through the change of law, etc., the proposals which have, will that help the sector in a big way? And how do you see the FPI, I mean the foreign FDI coming into the sector through these mechanisms, or FPI coming into this sector through these mechanisms? I mean, if you could throw some light on that. You're on mute.
So not an expert on the InvITs and REITs, but from what I gathered in discussing with my peers in the industry, it certainly mitigates some of the concerns that FPIs have had with the structure. How it is implemented and how the other remaining issues are addressed would determine ultimately the quantum and the speed with which we can expect FPI flows into these structures. Okay,
right. So it is. I mean, things are being made easier. I mean, that goes in line with the ease of doing business, motto of the government.
Certainly.
Right.
No, absolutely. No, this is definitely. We moved several from 143 third rank, let's say in 2014. To 63 or something, if I have the numbers right, 142 to 63. And this is several steps further in that direction. And I hope it, marks an acceleration in that direction. We should not, in cricket, if we are second, we become very restless and upset. So why should we accept any less in something that's a lot more crucial to livelihoods and job creation for the country? We should at least aim to get in the top 10 in the term of this government.
Right. Yeah, I'll ask a tax question to Arun. Arun, tell me about your experience. Tell us about your experience with the TCS mechanism which had come in last year, and it was quite a nightmare for many people. And how do you see the change of the law to TDS now? So what's your thought on that? And then there's a quick thing which I just before you answer that, there's a quick twist which is, I mean, while we are thinking that TCS on goods is gone and it will be pure play TDS, but the conditions which have been stated, probably a little bit of TCS is also still remaining in the system. So I mean, what's your take on that?
Right. So for me, this is something I'm struggling to get my head around. Given that we had TCS provisions introduced on effective 1st October 2020. So this is a provision that has lasted 9 months, and now we are shifting to a TDS regime. So this Okay, the intention seemed to be data collection. Given the TCS rate and the TDS rate, the intention is clearly data information gathering. But the struggle the industry went through to implement a complex provision like TCS across all transactions, procurement and sales, and the whole system improvements and ERP implementation. It was a good 2.5 months project to implement a TCS provision. And this was done during the pandemic. So given the effort the whole industry has gone through implementing a TCS provision, I would have personally liked to see it last little longer than 9 months. Now the expectation is the industry goes through the same drill for TDS provisions. Yes, there is a bit of ambiguity. There's quite a bit of ambiguity on coexistence of TCS and TDS. And also in terms of the transactions that are, at least the way reading of the law, the way I understood, if the transaction attracts TDS, then TCS should not apply on the transaction. That's seemed to be the bare reading of the law. But in terms of flow of transaction, TCS is from collected by the seller and TDS is recovered by the director. So the onus somewhere seemed to be on the director to see an invoice to see if TCS is charged, not charged, and somewhere take a position on TDS. So this will lead to a lot of back and forth between vendor customer on whether they should be TDS, whether they should be TCS, and this will take, and we'll always have these cutover transactions which will spill over between TCS and TDS, and there will be the ambiguity on whether it should be TDS or TCS. So if the data gathering is getting addressed to TCS, I'm still struggling to comprehend why would we move from a TCS regime to a TDS regime. That's my take. We will have to wait and see clarity on this, I suppose.
All right. So thanks a lot. That's a very practical way of looking at the thing, and your response was more somebody who's handled this thing in a very a company of your size who handled this thing very closely and have seen the issues coming up on the table. Yes. I'll change gear a little bit and ask Mr. Pachisia about that. All these measures which have been announced, tax, non-tax, and policy measures, the fund allocations, etc. How do you see that with the government's initiative of Atmanirbhar? How do you see Indian family businesses? I mean, true family businesses, and not necessarily the very large family businesses, but the smaller ones also. How do you see them performing in this scenario?
The question, Mr. Mukherjee, I take a cue from a Singapore-based fund manager. Okay, recently we had an interaction with him, and he was mentioning among one of the trends was that the next generation of family business owners, particularly including from the city of Kolkata, are actually settling down in Singapore, not because of any entrepreneurial zeal or something, but to manage their family office, basically. Okay. Now, so what I think is, if you were to unleash if you were to create that zeal for entrepreneurship, the way all the tax measures that have been put, for the first time after many years, we are seeing companies in India, large companies also announcing capital expenditure in India. That shows that there is going to be a good demand generation to serve that demand, and with the ease of doing business and the compliance easing up, there will be business opportunities which the entrepreneurs can look forward to. They had given up, going by the number of resident Indian millionaires becoming NRIs in the last 10 years. This zeal was going down, and that's why there was no drive in the family business owners, particularly the next gen, to do anything in India. Okay, this will get back because they have also realized one thing. For instance, pandemic hits everywhere. One, two is two is the kind of opportunities that India gives. So if you have to do a trade-off between quality of life and the business opportunities, it was the quality of life was taking people away, but the business opportunities now that will get created because of this multi-year directional change that India is going to go through. You know, when you have economy, your own country, double-digit growth and all, this will ultimately bring them back, because there cannot be a growth of family office from the money for which has actually come from the business. So ultimately, business has to be taken care of and it has to be grown. So I think that will be the most profound impact on family businesses, investing in family business, either brownfield growth, brownfield or greenfield, whatever.
Right. I've got one question for Mr. Sen. Thank you, Mr. Pachisia. I've got a question on on these measures which are being introduced, like advance ruling being going away. Then there's a shrinking of the compliance deadlines. Then settlement commission being closed down. Mr. Sen, any thoughts on what can be the genesis behind closing down of the settlement commission, or the advance rulings being replaced by a advanced ruling board, the authority being replaced by the board, is because people were getting quite a lot of benefit out of these mechanisms. So any reason for that?
I think again it's part of the government's policy, I presume, is that to prevent the dishonest taxpayer from an attempt to do forum shopping. So that's why probably they're reducing the platforms where the taxpayers can go. Because what was noticed, maybe that's I also have found at times that there are genuine reasons for you go to a particular forum, AAR, Settlement Commission, but there are also reasons which are actually not exactly your bona fide reasons for you to go for this forum shopping. So what was happening is that there were parallel proceedings going all over. For example, AAR matter is pending for various reasons, things were not picking up. And at the same time, assessments were going on. Similarly, ITSC also, what was happening is that they were taking a chance with the assessment proceedings. The moment it was taking a turn, it was not to the liking, probably people were going to the Settlement Commission. So that is one of the reasons probably to make it more, they are trying to consolidate these appeal forums or dispute resolution forums. For example, so far they have not touched the advanced pricing agreements and mutual agreement procedure. But they're considered to be a very bona fide, very straightforward dispute resolution mechanism. So that's one reason that I get. Second reason I get also, Kaushik, is that the government's zero tolerance with taxpayers when they want to go for a settlement after having done tax evasion. Probably ITSC has suffered from this. Although of late, to the credit of the ITSC, they were taking many types of cases. I'm not saying is that overall, but an impression was gaining around that for some taxpayers, that here is a forum which is an escape route. Once you are a jail in the assessment proceedings, here's a bail. So probably that is the overarching principle because of which probably they have done this. But coming to AAR, what I found is that AAR had already got a bit, the importance of AAR had already got diluted years back, 5-7 years back, when I was still in the department of this Columbia Sportswear decision, where the Honorable Chief Justice held that AAR is a tribunal. Earlier, that AAR's decisions were only were appealable in a writ under Article 226. But the moment it became a tribunal, the importance went down, and that is why it became what it is now. So, but here, one suggestion, the government could have, while doing all this about this AAR and ITSC and all, but one thing they are missing, because these are the forums which are giving a certainty, particularly AAR. Now, suppose you are not happy with the way it is progressing for various reasons, administrative reasons, logistical reasons, change in times, forum. So what they could have done is that, and they could have introduced the concept of private ruling. Probably, see, we can again reach out to the government with this, which is gone in very advanced countries, even in Singapore and other countries, where it's not that what issue that you want to win or lose an issue, but you want the government's position to be known to you before you take up a transaction or an investment decision, right? Because you have opened out so much of investment, FDIs, insurance sectors in this budget, and so much of capital expenditure will be coming. You have eased this rule.
I think Mr. Mukherjee himself is frozen.
I can hear you, Naresh ji, but not.
Yeah, I can hear the rest of you. Yeah.
Yeah, now we can hear you, Mr. Sen.
Yeah. So I don't know where when it dropped off. See,
you're, I mean, when we could hear your last sentence, then it went mute.
So what I thought, with all this positive environment coming in, so far as tax is concerned, a little bit of certainty was required. Pre-certainty, kind of a filter before you undertake a transaction. So that probably is missing here. And with the with the way this the powers or have been rejigged of AAR and even ITSC has gone. So I think this private ruling, where a private ruling is nothing but you approach the department. There's a body within the revenue department. It says that what will be the department's view on this. So once you know this, you avoid litigation and you assess your risk, business risk, and then you get on with the transaction, knowing fully well what would be the outcome. With some to a large extent, this advanced agreements are done. In advance, that is how I will sum up this issue.
Right. So, in your recommendation will be going for a going for a private ruling. That is something which should be introduced. Yeah. So we are almost at the end of our. Mr. Patricia, if you could add something very quickly, then I'll move to a common question for all. Before that, I'll have one hydrogen power question to Mr. Gupta. So, Mr. Patricia, quickly, if you could share your thoughts with what you wanted to speak.
Yeah. So I just realized that when I was talking about the tiger spirits of India unleashing, I was pretty, the impression that might have come out would be manufacturing based things, businesses. But that was just a example. But in my opinion, across all spectrums, opportunities will open up actually. So that's what I thought I'll clarify.
Okay. Thank you. And Mr. Gupta, this is the last question before the common question that we have. This hydrogen energy mission. If you could, in quick 2-3 sentences, give us some thought on that. Which government is launching. So if you could, overall something on that, 2-3 sentences.
You see, it's a evolving technology in renewable power worldwide, globally, and it has already been found success at a lab scale as well as at I will say a limited scale application. It is yet to be accelerated to grid scale solution, but definitely hydrogen-based solutions are more firm and stable compared to solar power or wind power, which are infirm power, and definitely need a little more further processing in terms of energy storage or even managing the reactive or capacitive side of the power, if I am not becoming more technical, to make it like to a thermal power. So there are certain challenges in each type of mode of generation of power, in which among carbon-free or carbon-neutral power, hydrogen is definitely will stand out in the long run, better than others. But it will run a serious competition with the battery. If we can move beyond battery technologies, like everything in future, has to be carbon free. That is what every society is aiming for, carbon neutral or carbon free virtually. So definitely everything is going to be electric vehicles and renewable sources of power. No more we are going to deal with combustion processes or coal-based processes. That's, I think, the life of those solutions are over now, done with. So that is how the future will shape like. But I will like to come to one issue which I did not cover earlier, is this package of 3,000 billion. Government is again giving to DISCOMs. It is a very piecemeal efforts again in attempting to make these DISCOMs, which also the finance minister claims to be monopolies, in the very budget statement. But still we throw good money after bad money. I would have loved to see a national DISCOM being proposed in the budget. We need to evolve a national DISCOM which is better governed, better technology driven, and can be an example to other DISCOMs in competition, in relativity, in performances, standards, services to be provided to consumers. All those could have been benchmarked, with those kind of initiative. And money would have been well spent, I will say. Otherwise, this is only postponing, the very life of the act. Rather, at times, I feel, if I'm not very aggressive, that this act should be folded back. It is not required. It has not served any purpose to the consumer, honestly, because it has not served the consumer anyway. You generate power at 2 rupee, 3 rupee. Why I have to pay 9, 10 rupee right in the city of Kolkata, which itself is claimed to be sitting on a coal mining, where there is no logistic cost. If you ask 9, 10 rupee from me in a power in Rajasthan or Tamil Nadu, I can well understand that it has suffered logistic cost. But what has it suffered in Bengal? It should be as good as pricing very differently. But nevertheless, the mindset is being managed and governed politically. So that is the rationale behind it. So what we need in the country is a top-down reforms in terms of and treating power purely as a commodity. It is no more somewhere we used to say it's a necessity, then we used to say it is a essentiality, it cannot travel across the borders. I must preserve it for my state only. So it does not make any sense anymore. When you have everything in plenty in most of the places in the country and it can travel so freely, what is the necessity to block it? By invoking...
Yeah, I mean, there are issues with the power sector. I mean, in quite a number of states that I've attended these chamber meetings, power is an issue. Somewhere is the cost, somewhere is the quality of power, somewhere is the distribution mechanism. Everything there. So I think hopefully we should see things getting changed over a period of time. In a country like India, probably it requires a little more of not only the political will but also the ability to implement, which will happen. Probably we'll see the things getting better. We've seen quite a few things getting better in different parts of the economy. So this also probably we'll see one of the days over there. So we are now at the end of our session. One final question to each one of you: that what is your one-liner on this budget? And if you want to touch upon just a one-liner, and if you could touch upon that, there's a good allocation, the fund allocation which has been made for infrastructure in the east, especially for the state of West Bengal. So, if you could give a one-liner on that, and I'll start with Mr. Khemka.
So I would say, and I think Naresh ji used several very apt and good descriptive words. If I might even be borrowing from some of them, but if I were to say, I hope this budget marks a pivotal point or an inflection point in accelerating, on the long road to ease of doing business, because that's the only way of sustainable job creation and prosperity for the country.
And
now, absolutely, I agree with Mr. Khemka. It should be viewed as an inflection point in the economy, in the country, around which we can build a strong businesses, enlarge the cake size, and meet the needs of the society and distribute in a manner. You see, one thing which we learned in our student times in college was it is not ism which is important, It is the delivery to the society which is important at the end of the day. How you enlarge a cake and how you distribute it to the benefit of everybody in the society. And that is what the ism is. US may be capitalist, but still it is socialist. China may be communist, but it is capitalist. But still they have served the society at the end of the day. And we are a stupid country where we say we are socialist and we remain communist by practices and capitalistic at heart. We ourselves are not able to balance our diversity as a government versus business versus society. That is the challenge India is carrying on its shoulders. So hopefully this budget
hopefully we'll see changes.
Budget should set it right.
Yeah.
At least it has pro-business first time.
Right. Thank you. Arun, what about you? What's your one-liner?
I'll give a tax view on this. It's a big relief. There was no tax rate increase. That's the underlying takeaway for me from a tax standpoint. There have been steps towards ease of doing business and FDI friendly, more in terms of TDS on dividend, which has been clarified. That's a big takeaway. No tax increase.
Great. And Mr. Patricia? You're on mute.
So after what Mr. Khemka and Mr. Gupta has so very well said, inflection, I think if I were to say one line, it will be excellent, better late than never, a job well done. But now the art lies in implementation, if it all can be implemented. But one descriptive, if you allow me, Kaushik, to speak on this that I think we are all as a society used to doing the best when our back is against the wall, actually, when we have been pushed to the wall. So be it the 91 movement, be it India in Australia, when the going is the worst, we actually come out the best as a society. I hope this also turns and we live for better times.
If I may just add, Mr. Mukherjee, taking cue from Nareshji's analogy of Australia, we can also say the budget was well played and well left. Well played on the ease of doing business pro-growth and well left on the taxes front.
Yeah, and Mr. Sen, how do you your perspective on this, especially from the tax policy side? You're on mute.
I echo the views of my fellow colleague panelists. Only urge the government to carry on this reform, and for us also, but let us learn along the way, because these are major reforms to be implemented, and all together to make it a success, not get discouraged by the hiccups there, which normally happen, and which makes the government again take the U-turn. We should all allow the government the space in all these reforms to it logically. That would be great.
Yeah. Good. Thank you. And we'll now move to the questions. We've got we've overshot our time. There are practically two questions which are there and these are pure tax questions. One is that what is the status of the goodwill depreciation on goodwill. To answer it in a lighter note, it will create a lot of heartburn for the tax specialists in M&A situations, and something which was being we could take for the last the few years post the decision of the Supreme Court. So that curtain has been drawn on that. And one needs to see, anyhow, it is no longer there for going forward, and one needs to see, how this gets interpreted for the past cases where it has been claimed and allowed, or which are in litigation. One things will pan out. And the other one is on charitable trust. The question is that what is the amendment proposed? The key amendment which is proposed is that the funds, the amounts received in corpus funds cannot be treated as use for application. They have to be put in those authorized or permitted investments, and then they can be used. And if any regular receipts are given to to fund the corpus, then at that point in time, do a backfill of the investment or the expenditure made from the corpus, that will be treated as an application. So, and similar issue for loans also. Repayment of loans will be, out of the receipts will be done. So that's the, in a summary, these are the two questions which are there. So with that, we'll come to an end to our panel discussion and the Q&A. Over to you, Abhishekta. But before that, I will thank each of the panelists. Thank you so very much for taking time off your busy schedule and being here for this much long and sharing your thoughts. We look forward to many more interactions in the future. And and also hope for betterment of the economy, and let's all hope that we come out of the pandemic after effects, as well as we all stay safe. Over to you, Abhishekta.
Thank you.
Thanks a lot for this wonderful session. I would like to thank all the distinguished panelists, our chairman, Mr. Abhijit Roy, and Mr. Arnab Basu, partner and advisory leader, PwC India, Dr. Lekha Chakraborty, economist and professor, NIPFP, Mr. Kaushik Mukherjee, our co-chairman of Economic Affairs Subcommittee and Chartered Accountant, Mr. Pulak Shah, Chartered Accountant, the sectoral panelists, Mr. P.P. Gupta, MD, Techno Electric and Engineering Company, Mr. Arun Ramachandran, Head of Taxation, Tata Consumer Products Limited, Mr. Prashant Khemka, Founder and MD, White Oak Capital, Mr. Naresh Pachesia, Founder and MD, SKP Securities and our family business co-chairman of CII, Mr. Kuntal Kumar Sen, Tax Policy Specialist and past Commissioner Income Tax GOI. It was a wonderful session, and you basically analyzed the budget from different perspective and also analyzed the sectoral implications. So I know that the final prints will come and there will be many more questions. So our tax advisory desk is there. So I would request the delegates, if there is any further question, you can come to us. We would again come back to you with some more sessions for throwing lights on the further developments. And also we would like to thank PwC for being our knowledge partner and supporting the endeavor. With this, I'll thank all of you and end the session. Thank you so much.
And from our side, thank you CII, and thank you the CII Secretariat for this efficient organization, as well as holding this session. Thank you very much.
Thank you so much.
Thank you. Thank you.
Thank you. Thank you.
Thank you.